Welcome to this edition of Advisor Insights. Joining us today is Joe Davis, President and Wealth Advisor at Stonebriar Wealth Management. Joe, always a pleasure to have you. Welcome back to the studio.
Hi, Jonathan. Great to be here again. Thanks.
So last week, 1.5 months after the fall of SVB, we saw First Republic go down. How bad is the banking crisis?
Sure, we do have a banking crisis on our hands, but this is very different from 2008. Hearts go out to anyone affected by these regional banks, employees and families and depositors too, to some degree. But it really is important to reinforce the fact that our banking system is sound and fundamental. Just taking a step back, this is very different from 2008. It actually looks a lot more like the 1970s when we look at the savings and loan issues at the time, where it's not a credit issue like 2008. We're currently experiencing a duration issue where banks mismanaged their assets and liabilities.
Okay, you mentioned that it's not a credit issue, so could you dig a little bit more into what a credit issue is with banking and then what a duration issue is when it comes to banking?
Sure, credit issue, think of 2008, everyone was worried whether there'd be money in an ATM and if banks would remain open. And while some regional banks have failed, it's been a very, very limited scope of banks, because the unfortunate reality is that bank runs are normal in our banking system. And not that it's healthy, but it isn't indicative of what the overall health and the fundamental strength of our current banking system is. So with a duration issue, for about 9 years, up until the Fed started raising rates last year, interest rates were held at 0%. So in 84% of that time, those rates were actually below inflation. So there was very little money to be made in your checking and savings account, as everybody remembers quite well and vividly, I'm sure, for many, many years. Starting last January, 10 rate hikes in a row from Fed Chair Powell in the Federal Reserve. And what happened here? Balance sheets became unbalanced. So really two things happened when rates went up really fast. The first is that banks had bought many assets at very low interest rate environments that they thought they could make a little extra money. But as they held on to those longer dated assets, interest rates rose up, and now all of a sudden they have to pay depositors a much more significant amount of money. And if you played with too much fire, took too much risk during that time, it really spelled a recipe for disaster. And that's what we've seen, unfortunately, recently. But again, a very limited scope of banks that took too much risk. And just as an example, during COVID, interest rates, the 10-year Treasury, touched 0.6% just a few years ago. Today, short-term interest rates are over 5%. So banks are paying a much higher interest rate to their depositors, but they're only making 0.6% on the other end. So with that, is certain banks that are unable to balance that balance sheet out, I fully expect there to be a few more bank failures, but again, not indicative of the overall health of the banking industry.
Like a 0 to 60 real quick, but 0 to 5% real quick.
Exactly,
in this case.
yeah.
Stonebriar Wealth Management, advisors for your life.
This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process described herein will be profitable. Investors may lose all of their investments. Past performance is not indicative of current or future performance. This is not a guarantee.